We are at 2 o'clock. Thanks all for joining for our first Gilman Hill conference call. Welcome to my office. I can't remember if I used this angle last week, but now you can see a little bit more of it. You know, my orchids are in bloom, so that's kind of cool. I keep them in the window all year, and then they all bloom at once. It's pretty exciting. So let's see. So thanks for joining again. And when I think I'll just kick off with following up. We'll do kind of the same thing from last week. We'll give you a broad overview of what's going on, what's news. Greg will update us on news, and then we'll talk much more specifically about the portfolios and what's going on in them and what the plans are. I think it's really important for you all to know exactly what we're thinking and what we're planning on doing. So in the note that we sent out last Friday, what I postulated would happen would be that we'd had a couple weeks of a ton of information, right? We found out about the fiscal plan. We found out about multiple monetary stimulus plans. We found out, not this past weekend, but the one before, about Abbott Labs having a test where they could start to test for COVID-19 in 5 minutes, and about Johnson & Johnson working on a vaccine. And then we found out all the details on the stimulus plan and all the tax stuff. So we've had a lot of news. And then, as we ended last week, what we expected was that we were going to go into where there wouldn't be that much news. And I think this is my silly analogy of the week, but the way I've been likening it is, in a period where there's a lack of news or a lack of information in an information vacuum, the worst thoughts can start to take hold. So my analogy has been, you know, when you're dating someone for the first time, and the relationship's new and they go silent on you or they start to ghost you, you just assume the worst, like, oh my God, something must be wrong, something must be wrong. And you know, in fact, maybe not much is wrong, but the phone got lost. But I think we could go into one of these periods like this right now, where for the next couple weeks, all we're going to see, we're not going to have any new exciting new news. There's no more fiscal stimulus coming in the next couple weeks. There might not be more monetary stimulus coming. We may or may not get any information on new therapies or drugs or vaccines or tests, but we are going to see the numbers go up a lot. We know these numbers are going up a lot, right? Everybody knows this. It's not going to make it feel good just because we know that they're coming. It's not going to feel great. So that's where I think we are. I think that one of the big questions I've been getting is, have we bottomed? Will it be a V-shaped recovery? Will it be a U-shaped recovery? I've been continuing to get this. And I feel confident and comfortable saying that we're in a bottoming process. The market bottomed out at this point so far, the market bottomed out last Monday on the 23rd. I don't know if we'll retest that. I don't know if we might break through it, but I think we're in a bottoming process. And I think that's true because we are getting the information right now on new cases. Like, even if it's not great, it's information. John thinks I'm silly to keep saying this, but I'm gonna say it anyway. With each day that goes by, I just feel grateful to get through it. With each week that goes by, I feel grateful to get through it because I know that we're one day closer to the end. For me as a portfolio manager at this point, knowing that Johnson & Johnson has a vaccine that looks like it's working, that could be out by the January of 2021, that to me starts to put an end date on this. So my worst case end date, you know, at least I can see it. At least I can see the horizon now, whereas a couple weeks ago we couldn't even see it. So with that, I think I'm going to turn it over to Greg for a few minutes to update you on news that's occurred since our last call, and then after that we'll get into actual portfolio specifics and what we're
doing. Okay, since last Wednesday, there hasn't been a lot of surprising news. You know, I think the week before we had much bigger events in terms of the coronavirus relief bill and the Fed's announcement for unlimited bond buying in the market. Nothing like that in the past week, but you know, still some significant news. The coronavirus relief bill passed on Friday officially. The only downside of that is that Congress appears to be planning on being out until at least April 20th. So hopes for another round of stimulus are going to have to wait for several weeks, and will probably take some time after they get back in order to get passed, if we do need that, which seems like there's consensus building that we'll probably need another round of stimulus beyond what was passed. The Fed didn't announce any new programs, but they don't have to. They've got an unlimited buying power to help stabilize financial markets. It did come out that their total assets on the Fed's balance sheet did pass $5 trillion last week. So I think that was up about $1 trillion over the previous week. And we expect that should be out, I believe, tomorrow. The updated size of their balance sheet should show, another $1 trillion being added to the market, and them buying mortgage-backed securities and treasury bonds. And it's expected that they're going to buy approximately $4 to $5 trillion worth of financial assets over the next few months. So while there's no big announcements from the Fed, I think it's the silent announcement of just each day them being in the market, adding liquidity, buying treasuries that is silently supporting financial markets around the world. And it's not just the Fed, it's also what the ECB is doing, the Bank of England, the Bank of Japan, some of the other smaller central banks around the world are helping to support financial markets in this time of disruption. As far as the virus is concerned, there has been some positive news. I mean, it's always pretty grim. Each day we get reports of the number of deaths and the number of cases rising in the U.S. But it is important to look at. There is some positive developments out there. It looks like Italy has probably reached the peak in new cases. It appears that the peak in new cases was March 21st. Since then, over the last 3 days, the number of new cases are down about 30%. So hopefully that holds. But that looks like Italy is starting to mend. I mean, there's still a lot of new cases to be had and a lot of deaths to come in Italy. So it'll still be grim, but it is improving. And they would join, if successful, they would join Korea and China in terms of largely beating the virus and starting to recover. Following Italy, it looks like Spain, Germany, and the Netherlands are in a position they're getting close. If they're not at the peak, they're pretty close. And then following them, UK and France and Europe, looks like cases are still rising. And of course, the US. There's positive signs in the New York area that New York may be closer to a peak, but while the rest of the country is still seeing continued growth in cases. So it's still a mixed picture in terms of the numbers, but it is encouraging to see some very large countries and economies start to move towards the peak number of cases and start to recover. I think one of the most important metrics in terms of the virus is testing. So we're up to about 100,000 tests per day. This is the one way to control the virus, is to be able to test large portions of the population. That's one of the best ways to get the virus under control globally. So we're at 100,000 tests per day. While that doesn't sound like a lot, we were at only 65,000 tests last week. And 2 weeks ago, we were only testing 15,000 people a day. So it's almost a 7-fold increase in the number of tests in the last 2 weeks, and that number is surely to go up. Other developments, there's not a lot of news. There's developments for a test for antibodies. That's something that's largely needed. If we have a test for antibodies, we can get people who are immune to the virus back to work and start opening up parts of the economy. That the test is being ramped up now. We're still weeks away from that being large enough to make a difference. We're also doing tests of various drugs. Hydrochloroquine and other drugs is a promising drug from Regeneron that looks like it has a lot of potential, but again, it's too early to tell the effectiveness of these drugs, and even the Regeneron drug, wouldn't be here, until early summer is when the manufacturing would be. They could manufacture and scale by summer. It wouldn't be really widely available till the fall. So those still, there's progress being made, but not enough to end the ramp up in the number of cases. As far as the economy, of course, we better get used to this. The numbers coming out on the economy are going to be pretty grim for the next few months.
Grim seems to be the theme of the call.
Yeah, this is
not as bad
really
as
exciting news.
Yeah.
But so we had initial jobless claims last week on Thursday, which were over 3 million claims, and tomorrow we'll get another report that'll be probably just as terrible. there's going to be a lot of economic data that doesn't look great, but that's something that we usually see. When markets bottom, they don't bottom with good economic news. It's when the data is actually at its worst that bottoms happen. Goldman Sachs updated their forecast for their economic growth this year. They've got GDP growth for the full year to be down around 6%. Obviously, the first and second quarters will be down much sharper before recovery in the third and fourth quarter, but they've got full year down about 6%. China, we still look to China for some optimism. This is where hopefully we're headed. China's cases.
Well, at least in terms of case growth, right?
Well, maybe in government controls, and yeah, let's hope not. China's cases peaked in early February, so we're about, at best, 2 to 3 months behind China, but the economy in China continues to rebound. So some economic indicators out of China, the coal consumption is now down only 8% year on year. Traffic congestion is down only 7%. These numbers had been down, as much as 50%, only a few weeks ago. And property sales, and this just shows how much pent-up demand is created by people being impacted by the virus. Property sales were actually up 30% last week, year on year, compared to the previous year. Elsewhere, stores continue to reopen. We're at Apple stores in China have fully reopened. Starbucks and Nike are 90% open now. They may be fully open, just it's the latest data from them. So there's hope in China that the economies can recover fairly quickly after the coronavirus is brought under control.
Yeah. So just one thing that I wanted to say before we totally move on to the portfolios and market returns. I know last night, and I'm sure we've all seen these headlines, that Trump was out saying the deaths could be 100 to 240,000. But just before this call, Greg and I were able to participate in another call with that American Enterprise Institute, where Scott Gottlieb, who is the former head of the FDA and one of the leading voices on this, was on. And he's actually, I would say, if anything, he's been overly conservative. Like, he thought Seattle was going to get way worse than it was, and it didn't, or didn't get as bad as his projections. But one of the things he said is that he still believes that the death rate could be under 100,000. And he said, and significant, and possibly significantly so. He said it's very hard to decouple and figure out what the projections that the government and different places reporting those numbers are. So I would just say, when we hear this, we still need to remember that this is super speculative, the numbers that are coming out, and there's who knows how it plays out. But so far, what we've heard from Scott Gottlieb has been accurate and trustworthy. Okay, Greg, do you have more, or should we get into portfolios? Oh, Greg?
Sorry, I had myself on mute. Do you want me to talk about the market returns?
Yeah, do you mind?
For the quarter?
That'd be great.
So the S&P ended the quarter down 19.6%, and I think that doesn't fully reflect the story of what was going on with stocks in the quarter. That I think that's in many ways is underestimating how much the average company was down. A lot of that is due to just the large mega cap companies tended to outperform the market. So while stocks like Microsoft and Amazon, companies with near $1 trillion market caps, are a large part of the index, were actually up, or close to being up during the quarter. The average stock in the market was down a lot more than 19.6%. The Russell 2000 index of small caps was down over 30% for the quarter. International stocks were down over 23%. So there was a lot more pain than that the S&P return I think reflects.
Right. So with that, that's our segue into saying our numbers did not keep all three of our portfolios underperformed the S&P and underperformed their benchmarks. And so I'm telling you that because I'm going to need to write the quarterly letter. I was going to start it this morning. I'm going to start it this afternoon instead, and we'll start sending out quarterly reviews. The numbers are going to be really hard, and they're not great. But here's my but. we're not going to lose hope. Greg has a bell on his desk, and it's like one of those little, front desk bells that I got him for Christmas as a joke. Anyway, to be funny, I called him on Thursday morning, the 19th, and rang the bell. And because Greg always says no one rings the bell when you're bottoming out. So I rang the bell and I said, haha, you heard it here first. So coincidentally, since then, we have, although we're still way behind the S&P in all of our strategies, we have started to outperform, which is nice and a big relief for us at least. Since then, our growth strategy is about 8% ahead of the S&P. The dividend income portfolio is about 5% ahead of the S&P, and the international portfolio at this point is right in line since that period. So on a performance basis, we're starting to feel a little more secure. And what was I going to say? So I think from there, I want to say one more thing too. A huge part of the underperformance is from having some small cap stocks, but in the U.S. dividend income portfolio in particular, it is from our exposure to energy. The energy index was down 52%. I think this is an opportunity and a miserable thing too. The companies that we hold, by and large, are fine. I know that we've said this on the calls over and over the last couple weeks, but these are the ones where we've spoken to the management teams. And but for Targa, which we'll work out of, but for Targa, what we own is really not just okay, but they're going to be fine. And they have a lot of they're the large pipeline companies that transport crude oil and natural gas and gasoline, and whether there's just a little bit traveling through their pipelines or a lot, the big producers who lease those pipelines, they need to pay, whether it's 1 gallon flowing through or 10,000 gallons. They need to pay for the use of those pipelines. So our companies are really, so far, and we've been checking in with them over and over, okay. So here's where we stand since last week. Since last week I segmented the portfolio and I told you here's a group of companies where about 72% of the portfolio where there's just no concern, right? Where we're fine, we know the dividend income will be there and we'll be safe and we'll continue on. Then there were 6 companies that I thought if this continues on for a lot longer than we anticipate, then then we might have a problem. And then there were 5 where we knew we had to get rid of them. Since last week, there are no new dividend cuts. Tanger, which has been on that we're worried about Tanger. Tanger's kind of moving into the we need to sell it too, but we've known that for a long time, and that's fine. So what we're actually doing, which we discussed, and we started this process officially yesterday, is we are selling off the losers that we don't think are going to recover functionally, and we're reinvesting in 2 ways. One, we're reinvesting in existing holdings in the portfolio where we have extremely high confidence. We think that we have just as much upside in these when the market returns, and we also think that that the dividends are safe and we'll be able to keep the dividend income mostly, if not entirely, intact. So we're doing that, and then we're also looking for new opportunities. So what we did yesterday was we used some cash and we trimmed Ford and Six Flags and Ryman where necessary, and we started to move into Magellan or Williams, depending on which one of those 2 you own, and Hannon Armstrong and Dow and PacWest. So that was round 1. And so you'll see some version of those, depending on if you were underweight those positions, you'll see some version of those probably hit your transactions or your confirms this week. Here's the next step. The next step is to continue to work out of the losers, which are unfortunately Ryman, which breaks my heart, and we'll work out of them slowly and strategically and make sure we get the right price for it when we sell it. So we'll work out of Ryman, Ford, Six Flags, Targa. Those are the primary ones that'll be sold first. And in the next order, we'll start to buy Compass, Navient, Enterprise, Hercules, and Iron Mountain. However, if this market continues to trade down and give us an opportunity, we might instead buy a new position in something like 3M, Cisco, or UPS. Those are what are on our short watch list. So depending on if the market gives us the right prices on 3M, Cisco, and UPS, we would initiate a new position. If those just hold up and we don't get the right price for them, then we'll sell off and continue to reinvest in the portfolio. Over time, both will happen, but I'm just not exactly sure, given how much movement there is in the market, I'm not exactly sure which one will happen first. To be honest, I kind of hope that I just see 3M and UPS bottom out. I would love to own those companies with 5% yields and the remarkable businesses and track records they have on paying dividends. So it is the opportunity to class it out. I think one of the biggest risks as a portfolio manager right now for us, for everyone, is is getting scared and being unable to do something and just freezing. So Greg and I are hyper conscious of keeping ourselves moving and informed and fluid and in touch with our portfolio, so that we don't do that, because this is the time where we can make some really amazing investments. And I'll tell you, it's scary to buy, and we just need to conquer that fear and do what's right from a mathematical and from a portfolio investment perspective. So that's where we are right now. The income is still flowing. Dividends are still paying each day. I mean, almost every day there's a dividend paying out. So it's really reassuring to see that. Greg, do you want to touch on some of the movement in the companies in your portfolios?
Yeah, I think first on the international portfolio, we have less of a need for a radical change in the portfolio compared to the equity income portfolio, and that's through a combination of owning just mostly mega cap multinational companies that and also overseas there's more flexible dividend policies. So they when profits are down, they cut the dividend by a little bit, or the dividend is based as a percentage of the profits earned. So the dividends move up and down. It's less rigid than in the U.S. So that will prevent companies from just completely canceling the dividend. So there'll be no need to radically change the portfolio. I like where our holdings are. Our changes are going to be more opportunistic, just to take advantage of any mispricings in the market that may occur. And there's some interesting companies, but the portfolio we have has a yield of around 6%. So the bar is pretty high, and we really like what we own. In the growth portfolio, it's a little bit different. We believe that all the holdings are going to be financially strong enough to survive until 2021, when growth should rebound. However, we are concerned that the virus may do some permanent damage to the long-term growth rates of some companies. We think it's possible that the U.S. consumer will rebound quickly once this is all over. But I think corporate spending, CapEx, and government spending may be slower to recover and maybe damaged for a longer period. It's hard to imagine many companies getting back to business and starting to increase their CapEx budgets after this happens. And some governments are going to be in a position, especially the federal government. Government spending may be less, and they may be less willing to spend on certain projects. So there is some exposure there. So as we look at the portfolio, there's some companies that there's areas of the portfolio where we'd like to have less cyclical exposure. So on Friday, we sold out of Caterpillar and bought into Thermo Fisher, a medical equipment company. There's other cyclicals in the portfolio, like United Rentals, Freeport-McMoRan, Materion, some auto-related names like Aptiv, and travel-related companies like Marriott and MGM Growth that we're taking a closer look at. We may not sell them all, but we may trim some from that part of the portfolio. But these companies only represent about 15% of the portfolio, and the portfolio, I think, is well positioned to thrive in this type of environment going forward. We own a lot of technology companies, consumer and healthcare companies, so I think we're in pretty good shape in the growth portfolio.
Greg, what would you say the one or two companies that you feel the very most confident in are in the growth portfolio?
Our largest holding in the growth portfolio is Home Depot, and it's one where they survived the housing crisis quite well, and I have the confidence that they'll do quite well in this and manage it appropriately, and they'll emerge stronger when the consumer comes back next year. In international, it's tough. It's like trying to pick amongst your children which one's your favorite. But I really like.
Funny, you seem to do that easily.
Yes. The Deutsche Telekom would be my Natalie. I mean, it'd be my favorite. The Deutsche Telekom owns T-Mobile in the U.S., which will be merging with Sprint. That merger will go through regardless of what happens with the coronavirus. As we've seen, there's no shortfall in demand for cellular data, and that company should emerge quite well once this is all over.
Right, and that mimics our, on the U.S. side, the investments in AT&T and Verizon, which should be completely fine throughout this. Oh, sorry. I'm going to open up to questions in one sec, but I just want to touch on one thing. Over the weekend and through Monday, we've heard a lot of headlines about dividends being cut, and there was a Goldman report out even that said, dividends are going to come down by 25% or something. This I do not believe applies to the companies that we're invested in. What they're talking about in this are companies that are going to take funds from the government. So a lot of travel and leisure, airlines, companies like that, we've assessed our portfolios and we do not feel that we fall into those. One interesting thing I think now versus the last time around is on that list that Goldman put out, they also put a list out of 40 companies that they thought had particularly incredibly safe dividends. Interestingly, 13 of those 40 companies were banks. And so what's interesting this time versus last time is that the banks are being asked to help in this and to loosen credit, to help small businesses out. So this time around versus being bailed out last time, the banks are being asked to help. And I think that encourages the safety of dividends at banks. So anyway, the point is when you're hearing this news and rhetoric about dividends under attack, I do not think that the companies that we own are likely to be part of that assault. Okay, I'm going to unmute everybody. And then if one person, I don't know how to do it more elegantly, there's like a function where you can raise your hand. Or, maybe, let me try it this way. Let's try a different thing. If you're on the phone and you'd like to ask a question, please just press *6 and that will unmute you. Or if you're online, you can just click on your microphone and unmute yourself. But feel free to ask questions and I'll just open it up to anyone who would like to ask them. If it doesn't work, I'll just unmute you all and we'll go free for all. Okay, anyone got a question? I hear someone.
Jenny?
Yes.
Hey, Joe. Hey. Quick question.
Sure.
Right now in the bond portfolio, we have quite a few that are triple Bs. Are you concerned at all that they're going to be downgraded?
So of the bonds, and not everyone owns bonds, but some people do. So those of you who own bonds, and here's the hard thing about answering this also, Joe, is everybody owns different bonds because it's unlike a stock, it's not always for sale when it comes in. So of the credit qualities that we own, we're totally fine with them. Whenever we buy a bond in the first place, this is the way we approach it. We say, if we're comfortable with the equity credit, which is lower in the overall debt structure of the company in the case of an insolvency, if we're comfortable with the equity credit, we must be comfortable with the fixed income credit. So we don't really care if it's a, A-, a triple B, a double B2. There will be some price fluctuation, but we're quite confident in the solvency and ability to continue to pay interest payments on all the bonds that we own. So there's no, I actually just went through them this morning again, and I'm like, okay, there's a very few where the prices have been kind of mixed around in the last week, but there's nothing where I have any actual anxiety. I think maybe for some municipal debt in the future, if a state like the state of California started to come under pressure, that could be tricky. I don't own any like state of Illinois bonds for people who own munis. So I think we're fine on the municipal side too. Most of our maturities are pretty short too. So I think we're okay on those. I don't have any hesitation on us missing any debt payments.
Okay, great. Thank you.
Yeah, no, thank you. Okay, who else has a question?
Hi, Jenny, Bill.
Hi.
Did you last week maybe talk about Gannett? I wasn't on last week. You didn't.
No, and I'm happy to follow. I don't think I spoke about Gannett. Gannett is really interesting. So Gannett's one where there's like a push and a pull going on right now. So what they do is they own, and by the way, I know there's one client on here who doesn't own this in her portfolio because she hates it with a passion. So don't worry, this isn't in yours. But so they own regional newspapers, local and regional newspapers. And we spoke to the CEO 2 weeks ago. We spoke to them again last week. And the push and pull there is that the share price is under significant pressure in no small part because the fear is that local advertisers will pull back. The push, I guess, then is that digital traffic is way, way, way up. So just before things got super ugly with all this mess, and we were speaking to the CEO, they were about to sell 2 huge properties. And the cash from those properties was going to bring the leverage down. I think they were at a 3.75 leverage ratio. They're going to use that cash, bring it down to 2.75. the cash that they make from subscriptions alone was more than enough to pay the dividend. The dividend's starting up again in May, so it's a little bit funky. The upside to this, and I need to follow up with them again and see where they stand, is that they don't have specific debt obligations. They just have one loan, but it's at a high interest rate. When I spoke to them a week ago, they were in the process. This wasn't official, but it was like, you know, wink, wink, nod, nod. They were in the process of using this opportunity to renegotiate that loan rate to a lower level. So Gannett, despite being ugly, could be just fine in this. So it's not on the, you know, it's not on the I'm freaking out list. It's on the if this continues on for much, much, much longer, then we have a problem. But for right now, they should be just fine. Thanks, Bill. Who else has questions? Bob?
George. I have a question regarding Macy's.
Okay, let's hear it. Hi, George.
Hi. My question is regarding Macy's.
Wait, but hold on, George. That's only in your portfolio because that's one of your legacy holdings. No one else owns it. So do you mind if we talk about that offline?
Oh, sure.
Okay, thanks. Sorry, do you have other questions that are more broad to everyone else's? Okay, sorry. Who else? I appreciate that George is throwing me a bone and asking a question, though.
Jenny,
Yeah.
that's Pat Noonan.
Hi, Pat.
Hi, I have a question. I was just looking on the stock market thing, and it says Gannett today suspends dividend and implements cost cuts to offset.
Oh my God, I hadn't even seen the highlight because I've been on all morning.
That's
okay,
that's
then
from
thank
USA
you, Pat.
Today.
Then I need to
So-
follow up on that. Thank you.
Okay,
Literally,
no
I've been on
problem.
the phone since like 8 a.m. without stop. Okay.
Sorry
thanks.
about that. Bad news.
No,
but
thanks
just
for being the
let
bearer of
you
bad
know.
news. I'd rather
Okay.
someone else than me. Okay, so then
Okay.
Gannett's now moving on to the list of the cost cut part is normal, right? That part was happening. But that now needs to move on to the list of things, which is a total bummer. Okay.
And there's a question in your chat window.
Okay, let's see. Let's see. Oh, yay. That's from Dale. Sorry, Dale, do you mind, because no one here is in like the high yield muni space. Do you mind if we talk about that off? I'll follow up with you on that one privately, if you don't mind. Okay. Anyone? Okay. All right, I'm going to take it off of mute just for a sec, just in case. All right, everybody's off mute now. Anyone got any?
Yes. When are you on TV again?
Oh, thanks for asking. I'm going to be on tomorrow, and you'll see the same backdrop here, and it's just an hour of my time. So don't think I'm neglecting you. I'm able to do both.
So you're not physically there. You're doing remote.
Oh yeah, I'm doing it from my office, just right the same way I'm doing this right now. Yeah. So noon tomorrow. Hopefully.
Where? What station?
What's that? Sorry.
What station?
Oh, it's CNBC.
I've been looking at this for a really long time. You know, those portable storage units in offices and stuff. And this
Wait,
is
yeah, I can hear
interesting
you.
because
Oh, shoot, hold on.
they're using them. Look at this.
Okay. Sorry. I think I muted everyone again. But I hope you all appreciate that. I know everybody's voice. Okay, so I'd say if you want to ask a question, do hit that *6 and ask. Otherwise, I'll give it like a few seconds. Otherwise, I think we'll wrap up. Anyone? Okay, so I actually recorded this functionally today. If anyone wants the recording, I'm happy to send it. Thank you all so much for participating. Please don't hesitate to call or email directly, and I'll talk to you soon. And we'll keep moving forward, and we'll get there, and we'll come out of this smelling like rose, hopefully, even if it takes a while. Okay, bye. Have a good day.